Welcome to the F-Sharp Podcast, presented by Harmoney Wealth, a podcast geared to educate you on all things financial. Co-hosts Tanner Bortnam and Adam Henning discuss various financial topics presented in a consumable and entertaining manner. Tanner is a certified financial planner, JD, and financial expert, while Adam is a marketing professional and small business owner. It's time to harmonize. Sit back and enjoy the episode. Your future self will thank you.
Welcome to the F-Sharp Podcast presented by Harmoney Wealth, a podcast geared to educate you on all things financial. I'm your co-host, Adam Henning, marketing professional and small business owner, and I'm joined with Tanner Bortnam, certified financial planner, JD, financial expert, and my personal CFO, and hopefully yours too. So welcome. This is episode 40. This episode is our first of 4 market updates for 2023. Obviously, the first of 2023 as we just wrapped up quarter number 1. Tanner, it's been an interesting quarter to start 2023, to say the least. Most notably, we saw some substantial volatility in the market, including the second largest bank failure in U.S. history, which we covered in a previous episode, the emergency episode 38.5. So with that said, give us a quick update on quarter 1, and then we'll move into kind of the fallout of SVB and what we've learned since then.
Yeah, what a quarter, right? I mean, who would have foreseen all of these things happening? Obviously this quarter, but then on top of that, the market's actually performing pretty well. Ironically, you wouldn't expect those two things to happen at the same time. But just kind of before we jump into the bank kind of issue, now that we know a lot more about it. First quarter, as I mentioned, markets were up. S&P 500 was up, 7.4%. Very good start to the year. NASDAQ up, so that's more the tech side of things, was up even more, 17.6% in the first quarter. I think it's pretty easy to say I doubt that they will keep that pace and be able to continue churning out those types of returns for the next 3 quarters. But hey, good start to the year. Going to take it. Got one of 4 quarters out of the way and started climbing out of the hole that we were in, at the bottom so far was last fall. So we'll see how the rest of the year plays out. Inflation continues to come down. At the end of March here, it was 5% year over year. So again, still high, and higher than normal, higher than what the Fed wants, but, a lot better than 8-9% that it was, in 2022. So, making progress there. Unemployment, also very, very low still. It's at 3.5%. As we've talked about on previous episodes, that's a good thing and a bad thing. As the economy needs to slow down, and as interest or as inflation comes down, one of the things that's expected is unemployment goes up. We're not rooting for that. It's just an unnecessary evil of kind of the situation that we're in, but that really hasn't moved yet. Unemployment, you hear a lot of people in the tech sector have lost jobs, but the economy overall still really, really low unemployment rates.
What's a normal rate? 4 or 5?
Yeah, probably around. I mean, again, we love seeing this. The lower the unemployment rate, I mean, obviously, the lower the unemployment rate, the less unemployed people are out there. So that means more people are working, the economy is working more efficiently and functioning really well. So it's, again, kind of an anomaly. We're in a weird spot that we are trying, and I don't want to say we, I'm not, but the Fed is trying to slow the economy, which will help inflation come down. But yet unemployment hasn't really gone up yet. So it is a lagging indicator, so it can take some time to catch up. But I'm pretty shocked that it hasn't really moved much yet with how much interest rates have gone up. And then, last kind of thing, speaking of interest rates, the Fed raised interest rates another 0.25% in March, bringing their federal funds rate to 4.75 to 5% is the range that they're at. There is a still a very reasonable chance that there'll be another rate hike here coming in May. We'll see. Obviously, we have another month or so to go before that one. They're meeting there, but there's still a pretty good chance that they'll bump up rates again, even with because inflation's still at 5, still being stubborn. So that's kind of a quick recap of the markets, inflation, unemployment, and the rate hikes.
So at this pace, are we in line with that soft landing that they were hoping for, or?
I mean, I
leading later.
No, you're fine. I think that it's. I think the Fed is gonna want to continue to tell us that we're on track for that. Obviously the Fed is made up of numerous people, and so some of them have been saying that's not likely. But as a whole, I think they want to keep that narrative out there because it, makes it look like they're doing their job perfectly. If they can keep the narrative there, do I think that that's likely? No. Is there a chance? Yes. I think that chance it's a lot less. I mean, especially with, the banking issues that we saw, with SVB and a couple others. They got it under control. Again, this isn't the Fed. That was more the Treasury and government. They got everything under control at that point and stopped, what they were calling is contagion and more runs on banks and continuing this same process. But there's still issues there in the banking system as a direct cause. Again, we talked about it in the special episode 38.5 or whatever you called it. But it's a direct cause of, the Dodd-Frank rules, the abundance reserve that the Fed has been operating under, and the very, very quick interest rate hikes, and then, some mismanagement of the banks. You add all those together, you're going to have some issues.
Any information that we've gleaned since that SVB fallout? I know 2 other banks have, been taken over or shut down, or what's the term there? But are we stepping into or getting any closer to some regulations to prevent this again, or how is everybody viewing this? We're about a month post.
Yeah.
About a month as we're recording this in April.
Yeah, it's got to be right around a month. It's obviously we know a lot more information than what we did at the time. It does, again, if you listen to our previous episode, I remember mentioning on there it didn't sound like there was any bad actions by the bank. Now it sounds like that may not be the case as more information came out. We didn't know that at the time when we were recording the previous one. Sounds like they made some poor decisions, not, again, I think it is to be determined whether any of it was malicious, but poor decisions were made, for sure from the bank side. But at the same time too, there's more information of what the government knew. And, from things I've read, it sounds like the government knew that this could have be a potential long before it actually happened. And one of the big indicators of it is the Fed's own book. It has more than $1 trillion in this exact same losses. It's just, and again, just a quick recap for everybody in case you didn't listen to that previous one. What happened with these bonds was SVB, and all banks do it, they buy bonds to try to earn some interest. Well, they don't just all go out and buy 6-month T-bills. They're going out and buying different maturities so that they have different durations on these. So some of the ones they had a long duration, and they may have bought these at 2-3% payout. Well, as interest rates continue to go up, the price of bonds go down. And so that made the bonds negative in their portfolio. Now, if they would have been able to hold all those to maturity, they wouldn't have had any issues. They would have gotten all their money back. But the problem was, because of all the things we talked about in the previous episode and the social media and some of the concerns with SVB and those types of things, they had to sell some of these bonds. They were basically forced to sell some of the bonds at a loss because they needed to raise that cash. So transition that to the Fed. The Fed has over $1 trillion in paper losses on the bonds that they own, but they're the Fed. They're not a business.
They play by the different set
exactly.
of
Yeah,
rules.
Correct. They play by their own rules. And I'm not saying anything nefarious is going on with them. It's just they're not a business. So they will have the ability to hold all of those to maturity. So those paper losses that are in there right now don't really matter because they will never be forced to sell like an actual business would. And that's the part where I get a little annoyed with, the government as a whole is like, this is happening to your own stuff that you have. How do you not realize that the rest of the economy doesn't get to just continue to run deficits? Like,
Sure.
if businesses, and we've said this numerous times before, if businesses ran themselves like the government, they would be out of business. They'd be bankrupt. So it confuses me when the government doesn't get that. Businesses don't get to operate like them. Like, you should have seen the writing on the wall. It was happening with your own bonds in your portfolio, Federal Reserve. So you can assume it's happening in the banks as well. And so anyways, it sounds like they had all this data ahead of time, and it just, didn't really do anything about it. Now, did they think there'd be a run on the...
So why didn't they do anything?
Well, I don't think
Why
yeah.
no bailouts or anything like 08?
Oh, well, because the bank wasn't big enough. So I think numerous things. One, bailing out the banks in 07, 08 was very, very unpopular. I think it's what was necessary to do to cause financial collapse of the entire economy of the United States. Could they have done other things? Sure, of course. Like we always say, hindsight's 20/20. But with the info they had, that's the decision they made. And because hindsight's 20/20, it's a very unpopular, whether you're Democrat or Republican, it's a very unpopular decision to bail out the banks. So I think that was one of them. Also, SVB was yes, it's the second largest bank failure, but it wasn't like Chase was having issues or Wells Fargo was having issues. Does it sting? Of course, it stings the economy when SVB or someone like that goes under, but it's not the size of what we were dealing with in 2007, 2008. So no real bailout there, but SVB did get bought out by somebody else.
Oh, they did it? Or is that news that we've learned since?
Yeah, we learned since. Yeah,
I know they were trying to find somebody to.
Yeah, I'm pretty sure they
run, but.
Oh no. Yeah, since then someone has assumed the asset, and like stockholders. I don't know how all of it worked out. I didn't follow it enough. Full disclosure, I was in Europe when this was all happening, so it was quite stressful to try to keep up with everything that was going on and be 9 hours ahead. So I'm not sure how all of the details worked out, but regardless, no one lost any money. The run on the bank didn't need to happen. And the federal government came in and said for SVB, I remember Biden was saying he wanted to back all money that was in there, not just the 250,000 FDIC coverage. Now we'll back it all. And so, they because of some of those things and building that confidence in it that, hey, if something happens with your bank, the government's going to step in and insure all of your assets. That I think is what helped prevent other runs on other banks and that, again, that contagion they were talking about. And so, yeah, I guess that kind of answer what your question was.
Yeah. So where's the confidence level now with a possible recession looming?
In terms of confidence in the banks or confidence in the economy?
I think just going more general and having that spill in the banking industry spill, but let's take this as an overall market standpoint. Where's the confidence level and how much did that affect it?
It shouldn't be very high. That's why I was saying at the beginning, it's kind of an interesting quarter because you have some of these, not so great things, some cracks in the armor, starting to show. Corporate profits are continuing to go down, maybe, or they will be lower when earnings season comes out here. But the markets were up. And it's kind of an oddity with that. Now, we always say this again, the markets are forward looking, and so maybe the markets are, pricing in some of these things. Like maybe they, think that interest rates are peaked or close to peaking. I know one of the charts that I look at does seem like the markets are a little displaced from the Fed. So the Fed, as of the last time I looked at the chart, expected to, potentially raise interest rates 1, maybe 2 more times this year and then stop, and no rate cuts in 2023, where the market itself has, 1 to 2 rate cuts built into the back end of 2023. So, I think there's some disconnect there of what one group thinks is going to happen in the other. So that might lead to why the markets were up so high or so much in the first quarter.
When you say disconnect, the market's outperforming what you think it should be based on
what
the Fed's been doing?
Yeah, because one of the sayings is don't fight the Fed. If the Fed says they're going to do something, like don't fight it, because if they do it, it has a direct cause. Like, like I mentioned with the bonds, that's the easiest example. If the Fed is going to raise interest rates, bond prices of existing bonds are going to go down. Like those two things are going to happen. It's not like, well, maybe they'll go down. No, they are going to go down. And so that's why there's this, this saying of don't fight the Fed. And that's where I think there's a little bit of that disconnect, because if, the Fed is saying, now again, they have every right to change their mind, but if they're saying, now we're going to raise rates 1 or maybe 2 more times and then pause, and the market is saying, I don't know if you're going to raise rates at all, and we actually expect you to lower interest rates 1 or 2 times by the end of the year. That's where I think that disconnect is. We'll see who ends up being right. Again, typically, and why they say don't fight the Fed is because the Fed gets to determine whether they're right or wrong. And of course, as we've seen with them, they don't like to make it look like they made a wrong decision. So they will plug along. Anyways, I just think that could be one of the reasons of, inflation is continuing to come down. That's a positive for the markets. We did avert, a banking crisis. I don't want to call it a crisis because I don't want to be a fearmonger, but banking issues. Yeah. Banking issues. There were issues. And if the government didn't act, there could have been other runs on banks, and it could have been a perfectly healthy bank. But like we talked about in the last episode, if any business just in one day loses 25% of their revenue, particularly bank, your deposits, if you lose 25% in one day, that's shutting down any bank. So the fact that they stopped that from happening, that's a huge deal. That's very, very positive for the market. So again, maybe some of those things got people. I'm not negative on the markets overall, but I'm not that positive. I think that was some really good returns in 3 months that I don't think the news necessarily was there to as a catalyst for that. I don't know where the news was to cause that.
So how much projection does the Fed have? I know this is a little off topic.
Yeah,
but
you're fine.
Is there a way to for you experts to see the data points and then listen to what they say and go,
Oh yeah.
Okay, it's great that you're saying this thing, but the data and the market says something else, and how big of a, I don't know what to call it, but a projection of confidence that seems to be a little bit false, like a false door.
Yeah, that's the hard part. So it's kind of a multi-prong answer to what you asked. So let's start with the Fed and their information. Their dot plot comes out every time they have a meeting, and it's updated from the current through, I can't remember, the next 4 quarters or something, of where they expect interest rates to be. And every person that's on the Fed board gets to put a dot on this on this graph of where they think interest rates will be. And so you can see where they're thinking and projecting. Now, again, they can change their minds. And if you go back and look at previous dot plots to what they actually did, some of their previous ones when they're like, oh, well, inflation isn't that bad, it's transitory. You remember us talking about that during, inflation's transitory. And that
was a nice marketing word.
Oh, exactly. They didn't expect, they didn't expect it to stick around, so they weren't raising rates right away. Well, then those dot plots were way off from what they actually did, because eventually they're like, oh crap, this isn't transitory, this is here. And then they've, started making moves, but it makes their previous dot plots way off. So, but you can kind of see, like at every meeting that you have, you can kind of see what they're thinking. And then of course, Fed Chair Jerome Powell gives a speech. And you can try to, he does a pretty good job of being, no, I would just say he's not a politician, but very politician-y, very lawyer-y. He's also not a lawyer, but, just like it's kind of factual, not a lot of definitives, leaves open the possibility so that they have flexibility. All things that I would do if I was having a meeting. I'm not going to paint myself into a corner, and he doesn't do that. So you can try to glean some things off of that, what he said at the previous meeting versus what he's saying at this meeting. So with that, I would say, you can get an idea of what they're thinking about. Now, the hard part is, the market isn't just the Fed, and the market is not just me, and the market is not just intelligent people who pay attention to this. The market is everything. It's fear, it's greed, it's news, it's, idiots, it's very intelligent people, Warren Buffett's of the world. It is everything. And so sometimes it does, like from my standpoint, I think it is disconnected right now. I don't think there was enough positive data for the markets to have, especially the NASDAQ, over 17% gain in 3 months. That means the economy, to me, at a rate like that means the economy is crushing it. And I don't think you could find a single person in the United States that's going to be like, yeah, the economy is just rock solid right now. Like, no. So, but we just had rock solid quarter for the NASDAQ. So that's where I think it gets disconnected sometimes, is you just, certain people or certain groups or certain, whatever, however it is, just get fixated on one area or one thing or one whatever, and it can cause, a lot of distortion in the market. The markets are here's another one. They always talk about, are the markets efficient or not? I don't know if you've ever heard people talk about that. I think the markets are extremely efficient most of the time. There are times where it just doesn't make sense. I think we're kind of in one of those. I'm not saying it's terrible and that the markets need to drop 17% by any means. I think it went up too fast, and so maybe we just kind of have a pause for quarter 2 and let some of the data catch up, and then over half of a year, the NASDAQ's up 17% or 15% or whatever it is. Okay, that is more reasonable now, because you have more time where it kind of pauses. So we'll see how quarter 2 works out on all that.
Generally speaking, as a financial planner, when you say something like that, are you just tempering expectations for the next quarter, or are you managing or moving in a way to kind of, lack of a better term, brace for that disconnect that you are projecting, or is it just kind of business as usual?
Again, a lot of questions there.
Or is that a terrible question?
No. They're good questions. Don't worry. I'm just there's numerous questions there, so I'm trying to figure out how to answer them all sequentially.
I'm the king of loading like 3 questions.
That's all right. So I wouldn't, I can only speak for myself, and I would think most advisors don't try to manage the investments based on a potential disconnect in the markets. Maybe this is, if a disconnect is like a buying opportunity or selling opportunity, maybe you do something like that, but I don't think you like really completely change your portfolio because of things being disconnected or what you view as being disconnected. So for me, for example, I think that this is a disconnect. Okay, well, let's. I have to throw the disclaimers out there ahead of time, of course. So none of this is advice. None of this is everything. Go talk to your investment professional. I'm just talking about some of the things that I did for my clients. So with that being said, quarter one, I thought the markets went up really quickly, particularly in certain sectors. NASDAQ, very tech, healthcare, different things like that, biotech. So those areas of my clients' portfolios, we rebalanced and I trimmed those back. They went up really quickly. Like, let's take some of these gains off the table. So a situation like that, yeah, I reacted based on the disconnect, but that's also just proper and prudent rebalancing of a portfolio. If there's a disconnect the other way and you think stocks are cheap and on sale, rebalancing your portfolio is going to automatically be buying you into some of those things. So, I would say that is more of what most advisors are doing rather than necessarily, completely changing things. The other thing, not necessarily from a disconnect standpoint, but just things that have changed. All my clients know I hated bonds ever since I started Harmoney Wealth until basically right now. And again, the reason behind that is it's not the bond itself. It's just interest rates were so low. The only way for them to go is up. This is even before we got into any of these issues. That's a simple rule of finance. As interest rates go up, bond prices go down. So when interest rates are as low as they can go, the only way for them to go is up. We just didn't know when they were going to start going up, and it happened to be last year. And so I didn't have any bonds for clients in portfolios because I'm like, this is a guarantee to lose money. Well, now the times have changed. I think we're getting closer to a top of interest rates. And so I've started adding some, bond ETFs into client portfolios because you can get a pretty decent return that you couldn't before. And, as long as interest rates don't continue going up astronomically, which most people think we're getting close to a top in interest rates, then the likelihood is actually that interest rates go down, which now would mean that your bond prices would go up. So there's a potential to have income plus maybe some growth on that. Again, not recommending that to anyone. Make sure you go talk to your own financial professional. But, that's just some of the things that we're looking at based on where we are in the business cycle.
There's a reason why we have a disclaimer at the end of it.
Exactly. Yes. And I still don't care. I'm going to make the disclaimers in the middle of it as well.
Yeah. No, I think you answered my question well. And I think it's important for someone like you that does this every day, and an expert takes what you just said as the normal day-to-day protocol and just normal things for granted. Yeah. Because that probably makes perfect sense. And it's like, well, yeah, that's basically a normal day or normal protocol for a quarterly whatever.
Yeah, rebalance.
Yeah. But it makes sense. So I think that's important to kind of address.
And
for
it's
someone that's not living it every day, or sure, that makes perfect sense.
And with that too, again, doing a rebalance for anyone out there doing your own finances, like or your own investment, doing a rebalance is really important. And investing, as much as people don't want to hear it, investing is supposed to be boring. Like, go look at Warren Buffett. Does anything Warren Buffett invests in, or is anything that he has done over his life, is it the flashy, sexy, like awesome thing that gets you really excited? No. And he's the best investor that we've ever seen in the history of the world. So it's supposed to be boring. It's supposed to be buy good companies and hold on to them. Buy good sectors, hold on to them. Yes, people get rich off Bitcoin. Yes, people got rich off of, the meme stocks. Yes, people get rich off of day trading. But those are the unicorns, and they just got lucky most of the time. I don't want to discredit all of them, but a lot of them, it was just luck and good timing. So unless you're that lucky person, then you got your 4-leaf clover that you carry around with you all the time. Just do the boring stuff and be like Warren, and you're going to be just fine. Just keep doing the right things a bunch of times. And you sent me something like this on Instagram, right? Making hard choices now and doing it consistently will lead to an easier life in the future, rather than the easy choices now, which leads to a harder life in the future. And I know we can't, show the
visualize.
Yeah, the visual that was on there, but I'm like, that's exactly right. And that's exactly what investing is.
I mean, the dude lives in Omaha. It doesn't get much more boring than Omaha, Nebraska. It fits perfectly.
and he drives, he drives the same car he's had forever. He lives in the same house he's had forever. He has nice things, but he doesn't continue to need more and continue to keep up with the Joneses and continue to do all those things. And I'm not saying that Warren lives a poor life or any of that, but with the amount of money he has, he could be living much more extravagantly, and he just doesn't, because that's not how he built his wealth. And he continues to do the right financial thing and the right choices.
That reminds me of something I'll bring off topic.
All right,
or
sure.
off the air. We don't need to talk about it. More tinfoil hat.
Oh,
but
all right.
So as we wrap up this episode, supply chain issues, global issues. What are some of the other things that we saw have an effect on quarter one as we wrap up quarter one and head into quarter two?
Yeah. Obviously Ukraine war is still going on. Doesn't look like that is going to be ending anytime soon. Again, I'm just going to kind of go over these. I don't want to get into any of the political side of things of any of it. We try to avoid that on the podcast here. But yeah, that doesn't look like that's gonna be ending anytime soon. It didn't seem to have as much of an impact last winter as what was projected, because Europe had a warmer winter. United States was able to get more natural gas over there to help than what was projected. But with wheat crop, different things, Ukraine was one of the top wheat exporters in the world. This will be the second summer now of less of that, so there'll be some issues with all of that, obviously outside of the war itself and the country of Ukraine. Where I don't want to necessarily say we're having issues with China, but we always seem to have a little bit of tension there, of course, with Taiwan and China believing that that's part of their sovereign nation. Taiwan believing that they're independent, the U.S. seeming to back Taiwan, but not fully, saying that we would, put military there if necessary. Again, not getting into whether any of that's right or wrong, just that's something going on, because Taiwan Semiconductor, for those who don't know, obviously makes semiconductor chips. It is one of, if not the most important semiconductor companies in the world, with not only the amount of chips that they create, but the sophistication of what they create. They work with a lot of American companies, and the chips that we are developing are far superior to anyone else in the world. And Taiwan Semiconductor helps make some of those. So, obviously there's some tensions there on that. Also, there's a new kind of alliance. I was reading a little bit about this called BRICS, Brazil, Russia, India, China, and South Africa. I guess
Sounds lovely.
Yeah, I guess they kind of got together and were like, we don't want to use the dollar anymore. We need to supplant the dollar. We need to, America needs to not be the world power anymore. And so they're talking about creating some currency that they can all trade in, which, again, whatever. I don't run the government, so I don't know if that's actually a threat. To me, on the face of it, doesn't really seem like it, but maybe it is. I don't know. I'm not an expert in that area, but that's going on. And let's see. Is there anything else that was really... No, that's kind of the main three. Is there anything I'm missing that you're aware of, kind of globally?
No, I didn't. I mean, that's the first I've ever heard of the
BRICS
Alliance.
I
tend to kind of turn that knob down quite a bit and just
and just kind of finishing up here on China. I have clients that ask a lot, should we be worried? And to be honest, I just don't. As I admitted, I'm not an expert in this area, but just thinking through the things that we all see in the news and know, and trying to be logical about it. On one hand, they're a huge economy. They make a lot of stuff. They make a lot of the stuff that we need. They have a huge military. So there's a lot of kind of scary buttons or scary things, hot topics that people can bring up and be like, well, what if they would cut us off and now all of a sudden we need to move all of our manufacturing elsewhere? Yeah, that wouldn't be good, man. That would hurt the economy. Now let's flip that. Does China want to cut off the United States? We're the ones that buy all their crap, So I think that it might be a hate relationship to a certain extent, but you kind of both of you need each other, and I at least I hope that the leaders of each country recognize that. You can dislike America for being a democracy, and we can dislike them for being a communist country, but at the end of the day, they make a lot of the stuff that we need and buy, and we buy all of their stuff, and I think if push came to shove and if they cut us out, again, would that be a big hit to the economy? Yes. But as we saw with COVID and again, not to get into the politics of any of that, but what our country was able to do with creating a vaccine and the speed of doing that, again, not getting into the politics, but that we created and did things so much faster than the rest of the world that if we needed to move manufacturing out of China, there are other countries that we could move that to. Would it hurt the economy? Yes. But there are other countries, that have wages that are lower than America, which is why people, go overseas for production. And they could move production to some of these other countries. Now, does China have a replacement of the United States to buy all their stuff? I don't think so. That's the one where I'm like, I really don't think so. I mean, maybe all of Europe. And even then, they don't buy as much as we buy. Plus, they're not really in good terms with China either. So, you're going to have Russia try to buy as much stuff as we... no. They need us as much as we need them, for good or for bad. And so that's where I don't see this becoming a huge deal. I think it's a lot of talking points, and I think it's political crap, to be honest, to just political posturing or whatever and try to, I don't know what the long game is. I really don't. They seem to have a long game because they get the same president who stays in forever, and ours changes, every 4 to 8 years. So I don't know what the long game is between the two countries, but I just can't see it like becoming where one is like we're done with the other, because you'd be biting your own hand, so to speak, to do that. So while there's always tensions, I think that's probably about where it will stay.
Sure. It's like a sibling relationship.
Yeah, kind of. You believe different things, but at the end of the day, you need each other. Maybe that changes 10 years from now. I just don't really see a viable option for either of the countries right now.
Sure.
So
that's not what this podcast is all about.
that's right.
So
I'm not a geopolitical expert. That's just what little bit
that sounds awful.
Oh, I know, but I gotta keep a finger on the pulse to a certain extent.
Absolutely. Anything else you want to add before we wrap up episode 40?
Nah, that's good.
All right. We hope this episode has been helpful. As always, thanks for listening. If you haven't yet, please like, subscribe, and leave us a review. We are now on YouTube and producing video content. You can see our beautiful faces if you're a regular listener to our podcast on Spotify or another podcast platform. Check us out on video form on YouTube. If you have any questions or suggestions, shoot us an email at podcast@financiallysharp.com. That's podcast@financiallysharp.com. That's Tanner. I'm Adam. We'll see you, and you'll hear us in the next episode.
This podcast is for informational and entertainment purposes only and should not be relied upon as a basis for investment decisions. This podcast does not engage in rendering legal, tax, financial, or other professional services. Investment advisory services are offered through Harmoney Wealth, a registered investment advisor authorized to do business in states where registered or otherwise exempt from registration. If you have questions pertaining to your specific situation, please contact Harmoney Wealth at 602-935-5155 or at harmoneywealthaz.com.